My name's Dave Dubeau, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey folks, welcome back. Today our special guest is David Priest. He is a real estate entrepreneur and syndicator zooming in from Houston, Texas. And David has been through a lot with real estate and scaling up from single families into multifamily and then into syndications. And that's what he's focusing on. And today we're going to talk about what he's up to, what the secret sauce is, what he does a little bit differently than some other syndicators. And that is using a principal protection program with his investors. So I won't spill the beans there. We'll get into that a little bit during the conversation. But David, welcome to the show. Great to have you.
Thank you so much. It's a pleasure to be here.
So David, give us a little snapshot of what you're up to and what your commercial group, Paratus Commercial Group, does, what your focus is, what your buy box is, that sort of thing.
I am not an operator. I'm a capital raiser for other people's projects. So we partner with other operators, either as a co-GP or as a fund. So I like to say I'm not raising money for my own deals, so I don't have any built-in biases. They're not my babies. And I look at them as if I'm buying the property myself. I underwrite it as if I was an operator. I was originally going to be an operator and decided I like dealing with the capital raising side of it a little bit better. And I always invest my own money in every deal. So I'm going in along with the investors, whether I'm a co-GP or a fund manager, depending on what the operators want. And I do place money with different operators and even right now, different asset classes. We're working on a storage deal right now in Houston, and I'd never done storage before, but I had a chance to partner with an incredible storage operator on a $100 million deal. So I jumped in and said, hey, I'll definitely do this. It might be a one-off, but I'm looking at more alternative assets besides just multifamily, but multifamily is always my primary focus.
Very, very cool. So there's really two parts to what you're doing, David. Number one is vetting the partners that you're going to be working with, vetting the sponsors, looking at the deals, kind of doing your own due diligence and underwriting. And the second big part is raising capital for those deals. So over the last number of years, a lot of syndicators, especially in the multifamily space, have gone through some rough waters. How, if at all, has that affected you guys?
I have been very lucky, and it's just based on market timing. I got really serious in the business in 2023. And what was going on in multifamily reminded me of the financial crisis.
Yeah.
And I mean, it's going through its own miniature version of the financial crisis right now, that one asset class. So I got married in 2008. Me and my wife jumped heavily in the stock market in 2008-9. We're buying everything in sight. We're index funds people. We're not stock people. But when people say something, oh, it's totally crashed, it's down 30%, that's when I want to buy. I start getting excited. Mm-hmm. Also, I do have some wisdom from previous people's mistakes. So I see that people mistakes over the last few years, a frothy market, using the wrong type of debt, having inexperienced operators, having the attitude, maybe some mentoring groups telling people that anybody can do it and anybody can't do it. So these things added up to a lot of problems. I have some wisdom from watching, it's like I watched the car crash and then I drive a little bit differently now because I saw the crash. So I'm a beneficiary of that as far as my experience, and it's helped me a lot.
Oh, definitely, for sure. So David, a lot of other people in the multifamily space and people in capital raising, which is your full-time gig these days, they've had a real challenge raising capital for multifamily because of all of that mayhem. Has that affected you, or have you kind of gone to fresh fields for new investors? What does that look like on your side?
It's definitely made it more difficult.
Yeah.
And even this year, I thought Trump gets elected. He's a real estate guy, 100% bonus depreciation. It's go time. Money's going to roll out there. That has not happened yet. People are going to wait until it's too late, probably to invest in these deals, and they start going up. There's a lot of that going on. So it has been more challenging. But one thing that's helped me is a lot of my investors are newer investors. And there are people you talk to that got in deals in 2020, 21, 22. They're in some bad deals right now, and they're just putting the brakes on everything because they're scared. So I don't really, I don't really chase people that have had a bad experience. If they had, I totally get it. But you just have to learn from your mistakes to try to do something different. But if people lose money or have bad deals, that's hard. My number one rule is the Buffett rule: never lose money. Real estate is not a home run game. If you want to brag about home runs, the bar, the 5X, the 10X, go to venture capital or angel investing. Real estate is something where you're going for solid returns, try not to lose money. If the market is great, you're going to hit some home runs. If the market's poor, you want to survive and get your principal back and never lose money. And if you do that, you're going to be great. But the quicker you try to get rich in this business, the longer it takes.
Well, I think Buffett also said, be greedy when others are fearful and fearful when others are greedy. So that kind of ties in nicely to what's going on with the market right now.
Right. I started buying deals at the beginning of 2024. So I was raising money for deals. I was a passive. I'm in more passive deals than active deals right now. So I was throwing money in as a passive on these deals too.
Yeah. So speaking of watching the car wreck, you've kind of had the benefit of seeing all the mistakes everybody else made. It sounds like you're trying to overcome some of that investor hesitation by doing this whole principal protection program. So I know we can't go into it full on because that'd take up the entire interview, but maybe can you give us big, broad strokes? How are you able to, protect your investors' principal with what you guys are up to?
It's an optional program and people have to pay for it. So
it's like insurance.
Right. Don't call it insurance. It's a principal protection program. I'm not an insurance agent. So let's not call it insurance. It's not insurance.
I said it's like
insurance. Yes.
It's a close cousin.
It's a metaphor. It's a metaphor for insurance. What we're doing is we're raising a capital reserve fund. So people will pay into a capital reserve fund. We're putting in an FDIC insured accounts, okay, with big banks. And people pay them an upfront fee. We pool all this money together. And then if I have a deal that goes bad, we're going to use the pool to bail people out of that deal. We're not guaranteeing investment results. We're not paying interest. We're not paying preferred. You put $50,000 in a deal, the deal goes sour. I make your $50,000 whole. Now, if they had some distributions or you took a haircut and they only got 30,000 back, I owe you 20, not 50.
And it comes out of that fund.
Yes, and I also have the term of the original investment. So if it gets bad year two, we told you're liquid for 5 years. I have the term of the original business plan to get it if needed. I'm hoping I don't need that, but it's a contingency. We told you're liquid for 5 years. I'll get it back. I might have to go raise more money. I might have to, make some moves if the market's worse than I think. But I think the basis right now is good enough. And my skill is looking at these deals is good enough that I feel really comfortable about it. Also, this is not something I'm going to do forever. Yeah. I'm going to do this for a few years. I'm going to get where I don't need it anymore because I'm big enough. I'm going to build my reputation on it. And then once I feel like we've got too much risk, I'm going to dial it back or stop it, keep the money in there for people. And then when these deals exit, if we don't have to pay out the money they paid, that money we're storing becomes mine. So it really is going to get paid out to people, or it's going to be paid out to me once people get an exit and get their full amount. But I've got to wait 5 years for it.
Interesting. So if somebody's doing like a minimum investment of 50,000 and they want to protect it, what more or less how much would that cost?
10%.
Yeah, that's
it sounds expensive, but you got to do the numbers on this.
Yeah.
You got a 5-year business plan. Okay. It's 2% a year, which is the same thing as an asset management fee or a hedge fund. They do 2%. I need it all up front because the problems are probably going to be in the first 2 years. And I don't want to collect payments from people. I don't want to deal with that. Also, at the beginning, when people do the investment, they got to make a choice. I'm doing this and I'm paying you, or I'm not. The deal starts going bad. You can't come back, and the house is on fire. It's by insurance on the roof. And once you pay in, there's no refunds. So if the deal is going good, I had attorneys put this together. The deal's going good. They can say, "Hey, I don't need these anymore. I'm going to cancel and get my money back." It doesn't work like that. Yeah. It is optional. No one's going to be forced to do it. It's a 3-page document you sign. You wire your money in. It's separate from my fund. It's separate from the operators. This is just a side bet on the side. And people should think if they don't want it, he's willing to offer this. So he's got some pretty good deals. And all my deals are doing good right now. I've had no problems because the way
I think that's really smart, David. Yeah.
Yeah.
Really
I mean,
smart idea.
we do fixed rate debt only, long term, 7 or 10 years. 5 years is an assumption is okay, but 7 or 10 years, I'm using operators that have been in the business 10 years. They're doing full cycle. We do great markets, great locations. I'm careful on the underwriting. It looks aggressive. I'm not doing it. We're not trying to hit home runs, but this should give people a sense of security that will back up what we say. And I also have personal money I can put into it. I mean, I've had a few operators say, will you personally guarantee this? I was like, hell yeah. I don't want people to lose money. That's why I'm doing this. So I will
So
take.
David, how you've got the fund, you also get into deals. So you get into deals as like a fund of fund model. You also get into deals as I think you said as a co-GP.
OGP, depending on what the operator wants.
Yeah. But are you still bringing in money from your fund? Is that what I'm understanding?
Yeah.
Or do you?
Yes, we'll pull money from the fund. And then the principal protection's a side thing. It's on the side, it's an LLC, and it's totally separate from the fund or any of the operators.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com. Okay, very good. So you've gotten into this whole capital raising thing. You've jumped in with both feet. What have been some of your learning experiences as you've progressed with raising capital?
One of my learning experiences is how bad other people are at it. I watch a lot. What my training when I was learning how to do this is I watched a lot of presentations, and also I do a lot of passives. So I'm doing passives. I'm watching webinars. I'm not doing as much now, but in the beginning, I watched like hundreds of webinars of people. I'd watch like one a day. On the deal I wasn't going to invest in just to see what they did.
See the pitch.
And it's like the George Carlin, I think he said one time, a lot of people have no idea what they're doing, and they're really good at it. And so people would come on late. They wouldn't be ready. They wouldn't be prepared. They wouldn't be dressed. They wouldn't be professional. I would look at this and take notes and like, this is kind of, not doing good. So you have to be very careful. And as a passive, I've had deals where I was going to probably invest in their deal and I set it up with investor relations and I'm on a Zoom call and they are 10 minutes late. Guess what? No deal. After 2 minutes, I'm zapped off. They try to follow up with me. I'm ghosting them. My time is valuable. So it's just about being a professional and respecting people's time. But also,
did you also find that people tend to overcomplicate things too early on and talk over their investors' heads and that sort of thing, or not so much?
100%. And like what my focus is education. So if people have not invested before and they're only not ready, I try to take them on, let's get you educated path. Got a lot of material on YouTube people can watch. It's all free. I don't charge for it. 5 hours on multifamily as a passive investor. Everything that I know about passive investing that I've learned so far, it's always obviously evolving. And the whole idea is to educate people so they have confidence and also so they don't make mistakes. What really blows people in this business is losing money or getting in with operators because they fall for the deck or they like the operator or they're flashy and they went to the Tony Robbins School of Public Speaking or whatever. That's not a good reason to invest with people. So you have to be really careful and do due diligence with operators. And you have to be skeptical of everybody and kind of look at these deals and also spread money around to other people, different asset classes, different operators. Don't pick a favorite golden child that you really love and put all your money in with them, because if something goes wrong, if they have a liquidity crisis, there's a financial crisis, or if they're committing fraud, which is familiar. I'm familiar with the deal in Texas. We just bought a deal in San Antonio. The operator was fraud. The bank took about 8 deals. This person had a sterling reputation. No one knew what was going on. And I know people that lost hundreds of thousands of dollars because they were giving him money because the deals were going perfect. Guess why they were going perfect when everyone else was not going so good? There was fraud. The numbers were all fake. They were raising money and throwing it into deals and doing fake. So if it looks too good to be true, it's too good to be true. So be skeptical. But I think right now, the basis we're at, and with some of the trends, I mean, it's go time to go with good operators because the basis is so low. There's no development going on. There's going to be even less because there's, especially the South, like in Texas, there's kind of a labor crisis because of deportations.
Oh God, yeah, my goodness.
So very hard to develop.
Workforce?
Very hard to develop. And one of my secrets right now is I'm looking for stuff that doesn't have a lot of construction.
Yeah.
I like the management value add, or I like the distressed sale because they're on bridge debt and all the CapEx got spent because they're great at construction. And we go in and we recapitalize 30% discount, get fixed rate debt. It's in a good area, which the location's obviously the only thing you can't change. Mm-hmm. So that's the first thing I look at. I usually kill deals in the first 5 minutes when they're sent to me, just based on the type of debt, the location, or the type of metrics I'm looking before I even look at numbers. If it doesn't cash flow right now, forget it. I can kill it in 5 minutes.
So David, when it comes to the whole capital raising side of things, what are you finding is working best for you these days for connecting with new potential investors?
I use LinkedIn a lot to bring people in. I also go to a lot of meetups. If you can meet people in person, shake their hand and talk to them 5 minutes, that's better than Facebook ads or 20 LinkedIn posts. Mm-hmm. So I like to be out there. Obviously love doing podcasts too, because it gets you out there and it's working even when you're not. But a lot of my investors are here in Houston. I'm very centric to Houston. So nice. If there's a real estate meetup across town, my car's gassed up. I'm everywhere in Houston.
Smart. Makes sense. What are the plans for the next 12 months or so, David? Where do you see things going for you?
Well, I think what's going to happen with multifamily, like the market in general, the kind of distress that's going on is going to continue for some time. There's whole to survive till 25, and I think it's sick until 26 now. And I think it's going to keep going. So it's a great opportunity for operators. I was talking to a really incredible operator this weekend, his acquisitions guy, and he said, "Oh, this is great. It's not getting any better, but it isn't going down either. It's just kind of flatlining." So the longer there's more distress, it's better. Eventually, interest rates are going to come down, and there's going to be good economic signs. Tim Cook and Donald Trump were standing together talking about $100 billion investment in the U.S. The kind of capital coming here, something is going to happen. The economy is going to get better. And once multifamily ticks up and it's hot again, people have some good exits, rates go down, cap rates could compress a little bit, and everybody's going to jump back in. But I caution you that at this moment right now, you need to buy the smile. I mean, are we bottomed? I don't know, but it hasn't really gone down much in the last 6 months. I think we're close to a bottom, and it seems like things are stable. So I plan on having some really good deals, but also I'm still cautious about don't go buy bridge debt. Don't try to hit home runs. I see Facebook ads where it's a 30, 35% IRR. Don't buy those deals. Find an operator that's fixed rate debt. They've been doing it 10 years, and the IRR is 15 to 20% in a great market with a great location. Yeah. I'm also favoring more Class A kind of stuff. If you can get something that's Class A, because the spreads between C and A still aren't enough. People are paying too much for Class C compared to Class A. And on my deals that are Class A, they're much easier to manage, not doing evictions. I've got deals with like almost no delinquency, so those kind of deals, if you can get a good deal in a Class A, it's preferable right now.
Most definitely. David, if people want to connect with you and find out more about what you're up to and get to know you a little bit better, where should they go?
The best place is always LinkedIn. I'm on LinkedIn all the time. You can see my contact information there, and you can book an appointment directly with me for an introductory call, kind of get to know each other and see if it's a good fit. And then once that happens, I'll put people on an investor list. I only do 4 or 5 deals a year. So I really focus for usually 30 to 60 days on a deal and then take a little bit of break. So I'm not overwhelming people with a lot of emails or a lot of fluff. When I have something good, I'll send it to people.
Awesome, David. Good stuff. Thanks for being on the show. Great to see you again, and thanks for your input.
Thank you so much. It was wonderful to be here. Thank you.
All right, everybody. See you on the next one. Hey there. I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.